Good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the week of 22nd of May. For those of you parents out there, I guess you should be looking forward to your kids' holiday, upcoming school vacation, so that we can all sleep late, right? Though we don't really care about the kids, like just us parents, we can sleep late. All right. I can see that Sunny is also looking forward
Yes,
to
man.
it.
My wife was just speaking to me, said, wow, finally we can like sleep in a bit later instead of waking up at 5 a.m. to do breakfast.
Exactly. Okay, so without much further ado, let's get into today's content. The disclaimer obviously is that SIAS is a registered charity. So whatever that we talk about today, especially when we talk about specific stocks, cannot be misconstrued as a recommendation. So please see a licensed financial professional before taking any kind of action in the capital markets. Okay, we do have the upcoming SIAS session. This one will be on the 21st of June. So as usual, we try to schedule it on the third Wednesday of every month in the evening. So again, if you're already a member, please use the QR code to drop your seat so that we can ensure that there's sufficient bandwidth for the Zoom session. For those of you who are still not SIAS members, you can join us for $1 a month. That's $12 a year, which is cheaper than a Grab taxi, I believe, during peak hour. Right. Okay, so a couple of things I want to talk about. First is relative strength. So it was quite interesting because we have this every Friday. We do have a interview with Money FM, and the Money FM, those guys were asking about the US market. So usually we talk about the US market. So it's quite interesting to see that the S&P 500 is performing in a pretty odd manner. So there are two indices we want to talk about. So the SPX is the ticker for the S&P 500, the market cap weighted version, which normally we use. The SPY is the ticker for the S&P 500 equal weighted, right? So you've got S&P 500 market cap weighted as well as equal weighted. The S&P 500 itself is market weighted. The whole point here is basically to try and take a look at what is the performance of the S&P 500 if, let's say, it was not given more emphasis or more weightage on the big cap stocks. Now, what I've been seeing here is, or rather what I've done is basically to take the value of the S&P 500 market weighted divided by the S&P 500 equal weighted, right? So it's basically just a simple ratio. So if you look at the y-axis on the right-hand side, all those are garbage numbers, doesn't mean anything. What we want to really see is basically the direction. Now, since the, I think maybe the first month or so of 2023, you can see that the line is going up over here. So basically what that shows is that the S&P 500 market weighted index is outperforming the S&P 500 equal weighted index. So let's think about this for a minute. So doesn't that mean that the big cap stocks are the ones which are outperforming the small cap stocks? Because if the small cap stocks are outperforming and if they're equal weighted, then you expect the line to be moving down instead of going up. But as you can see, it's quite a huge spike in the relative strength of the market weighted cap versus the equal weighted cap. Now, what that suggests is that the market advance you can see in the US is not really that broad-based. It's basically the handful of big cap names which are pushing the market up. And of course, we know who the usual suspects are. But before we move to the next one, the next slide, sorry, I just want to kind of point out that we keep seeing market moving up, and although we have got a lot of fundamental news which is not very rosy, but the market keeps going up. I just want to point out that this is actually not a broad-based advance. It's pretty much a what you call a big caps pushing the market upwards. All right. Okay, the next is who are the usual suspects? So let's take the fruit company that we all love. So Apple, yes. So Apple, really they don't make fruit juice. But if you look at the market cap of Apple, it's been on a tear. So it's been, kind of like more than doubled in between 2020 as well as 2023. That is the white color line. That is the market cap of Apple. Now, the blue color line is the market cap of the Russell 2000, which basically tracks the mid-cap companies in the US. So the total market cap of all companies on the Russell 2000, and there are 2,000 companies, is the blue color line. So as you can see, since the beginning of at the start of this year, the white color line is above the blue color line. So what that means is that Apple, one company, is worth more than 2,000 other companies, which are part of the Russell 2000 index. That's quite amazing, right? Is this red? Is this red or pink? So the red color line is the Toronto Stock Exchange, the market cap of all companies listed on the Toronto Stock Exchange, all share index, sorry. And that is again below the market cap of Apple as well as Russell 2000. So as you can see, this one company itself is bigger than the 2,000 mid-cap companies in the US, is bigger than the stock index of the Toronto Stock Exchange, right? And it is slightly below, maybe $500 billion below the FTSE All Share, which is basically the market index for the UK Stock Exchange. So as you can see, this one company itself, and not to talk about, the NVIDIAs and the Teslas and all that, it's already kind of like, holding up or rather is larger than some of the, next biggest companies out there. All right, so this is kind of anecdotal evidence as to, why the S&P 500 keeps going up, although the fundamental information is not that great. Now, the other thing I'll talk about is the financial sector versus the non-financial sectors. This is basically a chart that shows two lines. The white color line is the what you call the S&P 500, or rather the KBW Bank Index, which basically is an index that tracks financials in the US, divided by S&P 500 X financials. That means excluding financials. That's the white color line. Again, relative index, relative strength, right? So going down, it means that the rest of the sectors are outperforming the banking sector. If the white color line is going up, it means that the banking sector is outperforming the non-banking sector. So that's the white color line. And then the blue color line is basically the relative strength of the S&P 500 ETF versus the iShares US Treasuries 20-year bond ETF. So again, this is kind of a relative strength of equity markets in the US versus basically a government bond used in the US. So again, if the blue color line is going up, that means the equities market is outperforming basically the Fed funds rate. All right. Okay, I take it back. Not really Fed funds rate. Fed funds rate is basically 1 year, but basically the 20-year government bond yield. All right. So let's compare the two lines here. If you look at, and again, let me just have a spotlight. Okay, so if you look at this part over here, there's a little bit of a divergence. Okay, so the blue or the white color line is going down, while the blue color line is going up. Okay, but over here onwards, as we head into the great financial crisis of 2008 2009, the white color line collapses. Yeah, obviously, because this is a banking crisis in the US, and you have got the blue color line which is going down. So this is positive correlation, right? So as you can see, the white color line started coming down first before the blue color line started coming down. So what that means is that the banking sector basically leads the non-banking sector, which kind of makes sense, right? So whenever there's a problem in the economy, the banking sector will experience a stress first, and then your tightened credit markets. So the real economy, so you've got companies will then find more difficult to get loans, and that's where the economic slowdown happens. Okay, so that kind of makes sense. And as you can see, we have got some points where the correlation is not so strong, but generally when the white color line is down, the blue color line is down as well. When the white color line is up, the blue color line is up, so on and so forth. Until we get to this part over here. Okay, this is kind of like the mid-2021. So as the white color line continues going down, the blue color line continues going up, which is a bit stranger because what that suggests, right, is that although the banking sector is underperforming the rest of the economy or rest of the sectors per se, but the equity markets keep going off the rails. Of course, one argument is that, well, that's because interest rates were fairly low. Yeah, that's true. But from last year onwards, interest rates has been spiking, right? Yields has been spiking, but yet, as you can see, this ratio here, this line here still keeps going up. So this part here is pretty strange. So you have got a collapse of the white color line. This is, of course, the onset of the banking crisis. Started out with the Silicon Valley Bank, which kind of collapsed. So you can see here you got a huge drop, but then the blue color line keeps going up. So there is a kind of a divergence here, which is pretty strange actually. All right, which kind of leads into the discussion we had last week about what is keeping the market up. Is it TINA? There's no alternative. Is it FOMO? You're missing out. But we also have anecdotal evidence from the previous slide that kind of suggests that it is really the big caps which are pushing the market up. And generally, there isn't a broad-based advance. Now, next item here is Citigroup actually compiles a economic surprise index. So how it works is that Citigroup actually looks at all the relevant important economic indicators and compares the actual number versus the expected number. So positive surprise means that actual number outperforms the expected number better than expected. And then, of course, a negative number means that the actual number was worse off compared to expected. So, not so good, below expectations. So it's basically a whole bunch of different indicators that track this and then put it into an index. Now, obviously, anything above 0 means that there is, broadly speaking, most or all of the economic indicators outperform expectations. Below 0, that means it's the other way around. So we have recently headed into negative territory. So a broad-based battery of economic indicators more or less show that it is underperforming the expectations. Now, that said, of course, you've got the headline numbers like inflation moderating. You have got non-farm payroll, so on and so forth, which shows that the labor market in the US is still relatively strong, relatively tight. But if you look at things like manufacturing output, number of hours worked, so on and so forth, it's kind of slowing down pretty quickly. Not to even talk about the company's operating margins, which has come down quite a fair bit since beginning of this year. All right, so economic surprise is negative, which doesn't bode well for the economy going forward. What about savings? So Americans, well known for spending more than they can afford. But during the pandemic years, because they didn't go out to shop, they didn't commute so much, basically everyone was stuck at home. And you can see there's a huge spike in American savings, personal savings, seasonally adjusted during the pandemic years. Very high numbers over here. But of course, after the COVID pandemic was over, Americans started spending again, so on and so forth. And you can see the number now is very close to what is this, $80 billion thereabouts. That said, that is slightly below the average. But again, because of all the excess savings Americans have squirreled away during the pandemic years, this slightly below average number is probably nothing to, it's not going to move the needle, i.e. what it means is that Americans as a whole in aggregate still have got quite a fair bit of excess savings out there. So it's been rapidly being depleted, but still the consumption as well as the spending behavior Americans can still propel the economy forward simply because of excess savings. Also, not to forget that the average hourly rate of Americans as a whole has been trending upwards since last year, right? So Americans are making a little bit more money as well as excess savings, hence the consumption patterns can still move forward and therefore propel the economy forward. So a little bit of a funny story here. The doomsayers, I suppose that will include people like me, analysts, right, have been pushing back the predicted onset of the US recession for a long time. So the consensus way back in September 2022 was here that there wouldn't be a recession. So this was the what you call the consensus here. So back in September 2022, the consensus was that there'll be a bit of a slowdown, but the US economy will still be at the minimum 1% GDP growth. Okay, that was September 2022. Now, in November 2022, the consensus for most of the analysts out there basically kind of collapsed. So this was the trajectory, the predicted trajectory of the US GDP going down over here, and then negative GDP growth in the what we call second quarter of 2023. Therefore, its rate is a recession, and then rapidly improving from third quarter onwards 2023. That was way back in November. Come this year, January 2023, the consensus was that, oh, we're going to have a collapse in the GDP in second quarter as well as third quarter, but then recovery in Q4. And of course, this month, the consensus was that we are definitely going to see a much deeper collapse of the US GDP in third quarter, as well as fourth quarter will still be underwater, and therefore the recovery will then be in first Q 2024. So the funny thing is that as the months go on, it appears that analysts have been really far off the mark. Previously, they thought that there wasn't going to be a recession. Then they thought it was going to be a mild recession. Then now it's going to be quite a deep recession, as in minus 1% down. But it appears that now we're quite sure it's going to happen from Q3 onwards, which is now it's already close to the end of May. All right, from July onwards. Yeah. So I guess the idea here is that really, I guess it's quite hard to call it, catch a falling knife. But it does appear that, again, you look at some of the, let's say, a broad-based aggregate indicator like the Citigroup economic surprise, right? Instead of just looking at any one economic indicator, you just look at something like this broad-based. It does look as though things are heading south pretty quickly. So don't be fooled into thinking that equity market is going up, therefore everything is all right. It's simply because you've got very big names which are pushing the market up, but there isn't not an indication of a broad-based health of equity markets. Okay, so Sunny is on next. He'll be talking about economic indicators and some of the TAs.
Yes. So before that, I did a quick Google. So Benjamin talked about how big Apple is just now. I don't see Singapore SGX company's market cap there. So I did a quick Google, 810 billion. So this was compiled by Business Time on 2nd of April. So I think one Apple is like, there's 650 Singapore companies. So I think we can dwarf about 3,000 Singapore companies at least. So if you want to fish, you want to catch a big fish, you want to fish in the ocean, or you want to fish in a pond, that's the analogy that I'm trying to tell you guys. So let's go to business. So looking at this CME Fed rate monitor, so this calculated using the Fed fund interest rates. So you can see that last week we had a jump in the probability of a 0% hike or 0 basis point hike or a stay in the interest rate for the next meeting on 14th of June. So this is now very close to the 90% probability. So a bit of a recap what happened last week. For much of last week, right, the headline was that the debt ceiling, a deal is going to be reached last week. But then on Friday, the talk starts to break down between the Republican negotiator with the Fed speaker. So more or less, we see that Friday there was a bit of a pullback because this will also mean that the negotiation would have to go on for this week. And as we get closer to 1st of June, right, that will be the crunch time where we see the central bank will run out of funds. And then on Friday itself, we also had the Fed Reserve Chairman, Jerome Powell, saying that interest rate might not need to rise as much given that the tighter credit conditions of the banking sector. And then it also made the statement that they can afford careful assessment now on the impact of rate hikes on the economic outlook, a stance that is taken as a bit of a dovish stance by the market. Hence, you see in the early part of last week, the major indices actually rose a bit, and then Friday it comes down a little bit more. Now, to me, I think this is my own opinion. I think that statement doesn't really point to the fact that even though we might see in this probability chart that you see right here, we might see that there may be a pause in the interest rate hike for the Fed to assess the economic outlook going forward. But then that does not mean that for the next few meetings, the July, August, or even September meeting, that there will no longer be any more rate hikes. So that will bring me to the next point that I'll be talking about, the economic calendar that will be coming out this week. So this is so this week on Friday, we will see the core PCE price index, which is the personal consumption expenditure index. So we are expecting that the numbers to come in line with what was announced previously in the previous month of March. So coming in a number of 0.3%. So anything above would likely means that it will put pressure that inflation is stickier than before, and hence the Fed may need to continue to tweak the interest higher going forward into later part of the year. So this might not be the sort of the freezing point or the peak rate that we are seeing right now. And then on the lower part of the screen here, you can also see that we also have the personal spending month-on-month numbers expected to come in at 0.4% above the previous flat number of 0%. So if spending becomes higher, then it will mean that likely a recession might not be that much feared by the consumers. And then also personal income month-on-month, we are seeing a slight increase from the previous number of 0.3%. So 1% increase expected, 0.1% increase expected for this month number coming at 0.4. So these are the numbers that will drive what the Fed will do with the interest rate, whether we are going to freeze it for now or whether there could still be 1 or 2 more rate hikes coming into the second half of the year. So I'm not taking the statement that the Fed chair made last Friday as a statement that they will be keeping the interest rate at this level going forward and not raising interest rate anymore. So the door, I think, is still slightly open for further rate hikes. And then we have the earnings calendar as we draw down to the end of the earnings season. This week, we are expecting NVIDIA and Costco, which are two of the bigger caps that will be announcing their earnings this week. And those probably will drive the market on the US indices. So let's go to the charts this week. So this is the Dow Jones Index, like I mentioned. So during the middle part of the week, a lot of headlines say that we are likely going to reach an agreement on the debt ceiling. And then the market actually went up, but then Friday, that was the red candle down because the Senate actually said that they are still in discussion and nothing is finalized yet. So market is taking that as a dampener. So a little bit of pullback on Friday. So on the technical side, what does this mean? Where are we sitting on right now? So this line over here, as you can see, was the peak period that you see in June last year. So that was a resistance level and could become a support level now for the Dow Jones Index. This was also the level of the January low that we see last year, and we saw a bit of a rally for the month of January and February in the period of last year. So this is the support that we are looking at right now. Okay, and then on the top side, you have a double top during the January-Feb period, and then on the May period, we also have another top, so that becomes a triple top formation. The triple top formation is actually a very bearish kind of chart formation. It means that this is a very strong resistance level. Anytime the index go up and retest this level, which is around the 34,281 points level, it is likely to get sell down again because a lot of sellers are queuing up to sell above this level. On the support side, you also have a uptrend line connecting the low of October and March, which is still intact right now and not tested yet. So if there's any kind of a bad news on the market, this would be the line towards the green color line to see that market is still, the uptrend that we see since October is still intact. So we are sort of going into a squeeze right over here towards the second half of this year. And the technical indicators, at least from last week, is telling us that it's pretty neutral. You can see that the trajectory of the MACD line and the signal line is sort of a pretty minimum. There is no angle on the trajectory and sort of suggesting that we are likely going to be flat or moving in a sideways direction going forward. Although I do take note that the MACD indicator, the reading now is negative 36, which means that there could possibly be some kind of a negative momentum still embedded in the Dow Jones Index. On the RSI, the reading at 49.45, just about 0.5 point off the 50-point neutral mark. So I would not take that as any indication, although it's below 50, but it's still pretty neutral. So not much of a momentum presence in the Dow Jones Index right now. The 14 days moving average of the RSI is at 48.52, also pretty 1 point below the current reading that we have on Friday. So also pretty much neutral. So I think the Dow Jones Index would likely be very calm for the next week at least. And with the limited number of economic data and earnings data coming out, we might see that the focus might be on the FOMC minutes that will come out on Thursday. And then we will try to read between the lines of that report of that minutes and see if there's any kind of clues of whether Fed will continue to increase or will it be a permanent pause going forward towards the end of the year. Okay, so that is the reading of the Dow Jones Index. Next, let's move to the S&P 500. Now, S&P 500, okay, there is some headline saying that this is the most hated rally that we see so far because all the macroeconomic news that we see, what Ben went through just now was negative and negative and negative, and then market has been trending upwards and upwards and upwards. So what does this mean? What does the indicator says on this? So the broader index S&P 500, this is the capital weighted index SPX, which is different from the SPW that Ben talked about earlier. So you can see that the market is still pushing higher. We have a double top formation connecting the high of February and May. And then this time round, last Friday or last Thursday, we have a breach of this level at 4,195 again. So market is testing this top again, and whether this will become a resistance level or it will be a breakout will happen and becomes a support, a change in polarity, awaits to be seen. But my take is, as of now, I'm taking the reference from the high of February and early part of the 1st of May, this high as a resistance level and as a double top formation that you see right here. So it's still a bearish kind of chart formation. And the breakout that we see on last Thursday and Friday is not really convincing. You don't really have a big candle pushing above the resistance line, thereby telling us that this resistance level is totally broken through, but then I think this resistance level might still stay, and hence we are also going into a squeeze for the S&P 500. Connecting the low of October and March this year as well, we have an uptrend line, which still have a bit of a buffer between what the last closing price of S&P 500 is last Friday. So if there is negative news that's coming out from the market right now, S&P 500 could possibly go down all the way to the 4,000 handle, 4,000 index mark handle, and that would mean a 200 points drop for the S&P 500. So I'm not likely going to go long for the S&P 500 because of this big resistance that you see right here on this chart formation. Unless there's a convincing break above, then we have to relook at the chart on the longer term again to see whether this double top resistance kind of formation is going to become a support going forward. On the indicator side, MACD histogram reading positive 4.05, so a slight positive momentum in the index right now. But then looking at the trajectory, the angle of attack, I would say pretty much neutral or sideways kind of movement. Not really a lot of momentum building up in the S&P 500. Hence, the resistance level at 4,195 or even just slightly higher at the 4,204 is likely to hold for now, for this week at least. On the RSI, the reading is at 60.34. It's 10 points above the 50-point neutral mark and 10 points away from the overbought signal of 70 points. So thereby it says that there could be some healthy momentum in the S&P 500. Hence, it might likely push higher. But once it reaches above the 70 point, that will be the overbought mark, and hence market might see a retracement over there. So S&P 500, according to the RSI indicator, might still have a bit of bounce higher. Then that means that we could really test the 4,204 points level that you see on the blue line right here. Okay, the 14 days moving average on the RSI is at 53.81, so it's pretty neutral for the past week, close to the 50-point mark, and then we see a spike up last week because of the positive news coming out from the debt ceiling kind of narration in the market. So as long as we get pushed back from a conclusion from positive news coming out from the debt ceiling kind of situation towards June 1st, definitely it will provide more pressure towards the S&P 500 or the broader US index. Okay, next let's move to tech index. Now this is a convincing breakthrough of the double top formation that you see for the Nasdaq Composite Index, connecting the high of January as well as the high in May at the 12,269 point level. So this has now reached around the 12,657. That was the closing last week. And we also have broken through the high that we saw over here, which is around the 12,555 points level, which I was watching closely previously, because that was a double bottom formation somewhere in the March period of last year. And going forward, once we have broken this 12,269 and now went above 12,500, 12,500 might likely be a support going forward for the Nasdaq Composite Index if the rally on the Nasdaq, the tech-heavy index, is going to continue going forward. There was also a report that the divergence between the tech companies as well as the Dow Jones top 30 companies has been at the widest since 20 years back. So I think if that's really going to come, we are still going to look back at the tech companies to drive the market forward. drive the market higher, and those tech companies are likely the top companies that what Ben mentioned just now also. So not a broad-based kind of increase, but those tech companies will be where you want to look out for to get into a re-entry to participate in the rally if it's going to come. Okay, so on the technical side, support level connecting the low in December of last year as well as in March of this year, we have an uptrend line. So it's very far away from the support. We have around a close to maybe 700 points away from the last closing that we have to drop back down to the 11,000, maybe 800 level. So this is a very wide gap. It's on the top part of the Bollinger Band. So if there's any sort of mean reversion that's going to happen, the 20 days moving average, which is the basis of the Bollinger Band, is at 12,224. So do be careful if you are likely going to chase the Nasdaq Composite rally. Do look for support level around the 20 days moving average at least, and even on the lower 50 days and 200 days moving average, which is now the 200 days MA is actually very close to the lower bound of the Bollinger Band, and that would be the major support for Nasdaq Composite if you are trying to go long on the market right now for the Nasdaq Composite Index. Okay, next let's move to the local STI Index. So this is the chart on the STI Index. It has been on a downtrend for the past month at least. We are very close to the uptrend support line that you see right here, connecting the low of October as well as the March of this year. That is around the level of the 3,130 or 40 points level. The lower bound of that Bollinger Band is 3,164 if you want to take that as a reference. On the resistance side, of course, 3,300, we have all known that that is a resistance level for a pretty long time since the December of last year. And we also tested that around the April, May period of this year, and then we got this downtrend that we see right here. So where is STI likely going to go in the near term? So definitely, I think if the uptrend is going to hold for the STI Index, we need to have a bounce over here. So the 3,120, 3,130, 3,140 level is it's likely going to come in with some support because of the uptrend line that you see here. Okay, and this line that you see over here was actually a support of the March level last year at the 3,127, 3,128 level. So this is also a sign that buyers might be coming in around here for a short-term push up of the STI Index towards the downtrend line that you see, connecting the high of January and April as well. So a pretty kind of a range bound kind of trading, but in that range right now, we are on the lower bound of that range, and hence might see some kind of a short-term rebound from the lower bound of that Bollinger Band going forward. On the indicator side, MACD reading at negative 6.93, so negative momentum still present in the STI Index. However, I do take note that for the past few sessions, at least for the past 3 days of the last week, the momentum has been subsiding and the MACD line is starting to converge towards the signal line. And if we get a crossover of the MACD line above the signal line, that could signal the start of a short-term rebound towards the upper bound of the Bollinger Band or the upper bound or the downtrend line that you see right here in green. On the RSI, the latest reading is 37.19, so it bounced back up from the 30-point oversold mark, which happened, let me pull out that date, okay? So it happened on 17th of May, last Wednesday, where the STI Index actually breached the 30-point oversold mark, and hence that's why we see a rebound for the last 3 days of the week last week, and hence now the reading at 37.24 is a rise above the mark that where we go below 30. The lowest point it went was on that day on Wednesday was 26.66. So it's now closer towards the 14 days moving average, which is 37.58 of the RSI indicator reading. So if this momentum is to build up towards the 50-point level and then a break above the 50-point neutral mark, which means that the momentum might be increasing or accelerating, and hence a rebound of the STI Index could be in sight for the near term in the next few weeks. Next, let's move to the Hang Seng Index. Hang Seng Index has a pretty beautiful kind of a formation, I would say, going into a consolidation phase. We can see that the March talked about a golden cross that happened in the early part of this year in January, where the 50-point moving average crossed above the 200 days moving average. Market or technical analysts view this as a very bullish kind of signal on the longer term, and hence probably towards end of the year, we might see a rally on the Hang Seng Index as long as the golden cross is able to maintain its shorter term index moving average above the longer term moving average. Okay, then after that, we have a crossover again. You can see another red cross over here with the red cross over here. So what this is telling us that even on the longer term moving average reading, right, the MA is crisscrossing against each other. And that will mean that you can see there is no angle of attack, there's no kind of a trajectory going on in the longer term MA. What is likely going to happen is like maybe in the short term, mid term, and even long term, we are likely going to see a sideways kind of movement. So a range bound kind of trading might likely happen for the Hang Seng Index. So on the support side, you can see year-to-date low is at the March level over here, which is the 18,829 points level. The latest reading we have is at 9,500. So anything that comes down and retests the 19,000 handle would likely be an opportunity to get back in. However, as this is a range-bound trade, so the Bollinger Band might be your best kind of indicator to use. So and when it goes below the lower bound of the Bollinger Band and then it spikes back up above towards the upper bound of the Bollinger Band at the 20,000 handle, it might be a good time to just play within this range for now for the Hang Seng Index. The MACD indicator now reading at negative 35, so definitely there is a negative momentum, so we might still be heading downwards towards the support level of the year-to-date low in March. On the RSI indicator, the latest reading at 43.02 is also below the 50-point mark and below the 14 days moving average of the RSI at 45.86. So momentum is still weak in the Hang Seng Index. So this might be a kind of a signal that we might see further downside in the Hang Seng Index, but definitely the year-to-date low at March would definitely be the point to watch if you're going to get back in on the Hang Seng Index. Okay, so that is what I have on the technical side for this week. Anything to add, Benjamin?
Yeah, so one thing, just came across a Reuters article that was written late last week. So apparently, SocGen, which is the French investment bank SocGen, right, has actually done a analysis into the S&P 500. So the hypothesis is that most or if not all of the market advance is really due to the hype behind AI. So AI related stocks like Nvidia, Google, Microsoft, because Microsoft has got a $10 billion investment in OpenAI that runs ChatGPT, right? So excluding all these AI-related gains, the S&P 500 would have been down by 2% year to date, but obviously is up about 8% year to date. So the hypothesis here by SocGen is that it's really because of the hype behind all the AI-related companies, which is driving the gain in the S&P 500. So anecdotally, that ties in with your TA on the NASDAQ, because obviously, in the last 2 days, nothing fundamental has happened, but yet the NASDAQ seems to have spiked a little bit, although there was profit taking on Friday. All right, so with that, we're going to end today's conversation. So thank you very much for joining us as usual. And thank you, Sunny, for the illuminating TA. So we will catch you again next week.